Okay, let's dive right into this. We're always trying to figure out what makes Wall Street tick. We think about these super complex algorithms, deep dives into earnings reports, all that stuff. But what if I told you one of the most important factors is something much closer to home? Something you can literally see right in your own neighborhood.
It kind of sounds like a trick question, doesn't it? I mean, what on earth could possibly connect how many people in your town show up to vote with the massive trillion-dollar decisions being made in the world of high finance? Well, it turns out the connection isn't just real, it's actually incredibly powerful, and it helps explain where a huge chunk of the world's money ends up going. And to really get why this matters, you have to appreciate the scale we're dealing with. Get this, 78%. That's the slice of the US stock market owned by what we call institutional investors. We're not talking about you or me buying a few shares here. We're talking about gigantic pension funds, insurance companies, and investment firms that manage trillions, with a T, of dollars for millions of people. Now, when you're managing that much money, you run into a huge, fundamental problem. It's really a trillion-dollar question. How do you decide which companies to trust? I mean, you're investing other people's life savings. You've got to be pretty darn sure that the people running these companies are going to do the right thing. In finance, they have a name for this. It's called the agency problem. It's that classic dilemma, right? It's like if you give your car keys to a friend, how do you really know they're going to drive carefully and not take it for a joyride? It's the same thing here. How can investors who technically own the company trust the managers who run it every day to actually act in their best interest and not just their own? So how do we solve this? Well, we usually think about what's on the left here. Formal governance, the official stuff. Laws, contracts, regulations. These are the written rules of the game. But there's this whole other side to it that researchers are realizing is just as, if not more, important, and that's informal governance. This is all about the unwritten stuff: trust, reputation, and the social norms that tell us how to behave. And that right there, that informal side, brings us to the absolute key concept that unlocks this whole puzzle. It's something researchers call social capital. You can think of it as the invisible glue holding our society together. So what is it exactly? Well, put simply, social capital is kind of like the trust infrastructure of a community. It's all those shared values and networks that make people more likely to cooperate with each other, to trust each other, and to just generally act ethically. It's that feeling you get in a place where people have each other's backs. Now, this might sound a little abstract, but it's not. Researchers have found some really clever, concrete ways to measure it. They look at things like voter turnout, right? How many people bother to respond to the census? Even the number of nonprofits and community groups in an area. Because a community where people participate, where they vote, where they join things, well, that's a community with high social capital. And boom, that takes us right back to our opening question. Okay, so now that we have a handle on what social capital is, let's connect it back to those trillion-dollar investment decisions. This is where we get to the core finding of the research. And honestly, it's pretty mind-blowing. And there it is, the big reveal. What the researchers found is that these massive institutional investors, they consistently and systematically put more of their money into companies that are headquartered in places with high social capital. It's like they're using the health and trustworthiness of a company's hometown as a proxy for the trustworthiness of the company itself. Pretty wild, right? And we're not talking about a tiny, insignificant effect here. No way. The study found that if you take a county's social capital score and increase it by just one standard deviation, a totally normal statistical jump, it's linked to a 5.5% increase in ownership by these big institutions for the average company there. So this hidden metric of community trust, it has a very real, very measurable financial impact. But wait, it gets even more interesting. Because this effect, it isn't the same across the board. The value of this informal trust, it really, really shines when other kinds of information are hard to come by. Here's a great way to think about it. Trust is most valuable in the dark, right? When things are murky, when a company is a bit of a black box or it's facing some serious challenges, investors have to rely on more subtle clues to figure out what to do. And that's when a community's social capital becomes this incredibly critical North Star for them. And the research totally backs this up. The connection between a place's social capital and how much money it gets is way stronger for smaller, less-known companies, the ones that don't have dozens of analysts following their every move. And it's also stronger for firms that are actually performing poorly. It's in those moments of uncertainty where investors are basically asking, okay, can we really trust these guys to turn things around? And they look to the community for a clue. Okay, so what about the investors themselves? Because they're not all the same either. You've got your transient investors who are trading in and out really fast. And you've got quasi indexers who own a little bit of everything. For both of them, trying to watch every single company like a hawk is just impossible. So what do? They use social capital as a shortcut, a pretty reliable proxy for good behavior. But then look at the dedicated investors. These guys take huge, long term stakes and they get their hands dirty, actively working with management. And because they're doing all that deep homework themselves, they don't really need to rely on that community trust signal.
So let's just zoom out for a second and think about what this all really means. Because this isn't just a quirky little story about stocks and bonds. This is about the very real, very tangible economic value of our communities. The researchers themselves put it perfectly. They say that the trust that grows out of local social norms, it's not just some feel-good idea. It actually acts like a lubricant for the whole economy. It reduces friction and just makes it easier for money to flow where it needs to go. So, at the end of the day, here's the big takeaway. The health of your community, that level of trust, of participation, of cooperation, it is not just a social benefit. It is a real, tangible economic asset. It literally influences where trillions of dollars get invested, and that in turn impacts everything from job creation to innovation. The social fabric of your town has actual, measurable financial value. And that, well, that leaves us with one last, pretty powerful question to chew on. If we now know for a fact that trust is a valuable asset, one that shapes our entire economy, then how do we start investing in it? What does it actually mean to build up the social capital of our own communities? Now that's something we're thinking about.